and good evening. You're listening to the new WCEG Network on WCEGTalkRadio.com or watch us live on your smart TV, YouTube, WCEG Network. I'm Dr. Charles Ross, the host of Your Personal Finance for the next hour or so. We're the worldwide community empowerment group where we speak life into the community. Like us on Facebook, follow us on Twitter and on Instagram at WCEG_talk_radio and at WCEG Network. And of course, this disclaimer that the topics and opinions of the show and its hosts are completely mine and the host, and WCEG Network has no liability for that. I am very excited to once again introduce some of you guys. I've known this young man for about 25 years. He's James Brown. He was born in South Carolina, Utahville. I hope I said that right. In 1952, he's the eldest of 4 children. It includes 2 brothers and a sister. And he spent some time in New York City, my hometown, in the Bronx. I don't know if I knew that. He spent 20 years in New York, received an academic diploma from Vander Childs High School, very familiar with that, and a Bachelor of Science degree in accounting from Fordham University. After graduating from Fordham, he worked at Arthur Andersen CPA firm for about 3.5 years, where he developed his passion for taxes. He received a master's degree in taxation, and he's a certified public accountant, and also, from my understanding, also a lawyer. Is that right?
That's right.
So he's got just a lot of education going on here. He is really, really ramped up. And he's had probably, 40 years experience in taxes?
Yes, absolutely. About 40 years of taxes. I love it.
You gotta love it doing 40 years. You very rarely find somebody that has done something, for that long a period of time. And just, personal disclosure, he was my CPA and accountant years ago, and I reconnected with him because this is tax time. But we're not going to talk so much about taxes as much about something that a lot of people don't think about, and that's wills, trusts, and estates. And I think a lot of people don't talk about that because, we always talk about how you're going to pay it forward. You've got to make sure that you got your affairs in order so that you can do that.
Right.
So, just overview, what do you see as the status of taxes and accounting and all that kind of stuff right now in America? I mean, it's so complicated right now. Nobody could do their own taxes. Right. It's too complicated. You can't keep up with all the laws.
Exactly.
Even with TurboTax and all these programs out there. I don't advise anybody to do their own taxes. You just can't keep up with that stuff. So what is your overview of what's happening with the whole area of taxes right now?
Well, the whole economy is controlled by taxes. I mean, they use the tax law to furnish and to run this country, and then they determine who pays it, because our congressmen, our House of Representatives, and our Senate, and our president, they count on taking our hard-earned dollars and spending it supposedly to protect us, and we want to protect us, but it's who are they taking the money from? I say, in this economy and in this world, you need to either be rich or poor to not have to worry about taxes. The government gives the rich the opportunity not to pay. It gives the poor the opportunity to receive, and it gives the middle class the burden to pay. And so therefore, the middle class pays all the taxes. When they start talking changes in tax law, it affects the middle class. They giveth and they taketh away. They create things that it's not easy to do. I mean, TurboTax and all that. I mean, they've got a lot of things in there, but it's a program. They don't try to get to know you, know what you're doing. They've got a format that they're following.
Right.
So if you're looking for someone to minimize your tax, maximize your benefits, you don't need a TurboTax. You really need a CPA that's going to sit down with you and try to understand you as well as apply your situation to the law. So I say you shouldn't try to do this yourself. I don't think so. Now, if all you have is a W-2 and nothing else and a few children, then you're fine. But if you're moving forward, if you're aggressively growing your wealth and you're trying to protect things and you're saving for the future, you need someone to sit down and talk to.
Exactly. And someone that gets to know you over the years and know the things that you're planning for and want to do.
That's right.
The one thing that is interesting to me is that if the American consumer, just like you just shared, knew exactly what was going on, how politicians, who have their hands out when they have to run. So I get it. They got to raise millions of dollars.
That's right.
And one of the things, matter of fact, pretty much the only thing they usually have to give their constituents who pay, for them to run, to donate to them, is tax breaks.
That's right.
And they're going to have their ears. So if you got somebody over here giving $100, where you got somebody over here giving 50, 100,000, whose phone call are you going to take?
That's right. That's exactly right.
So, they would say, I heard Jimmy Carter, our former president, say that America is not necessarily a democracy, it's oligarchs, which means 1% are controlling. And so you see now the conversation that I've been seeing is that, we're dickering over $1,600, $2,000 one time, and then you're giving these billionaires hundreds of millions of dollars in tax breaks.
Absolutely.
Something's wrong with that picture.
Yes.
And we know that, because if whenever you look at the legislation, like on this COVID thing, it's probably like 500 or 600 pages.
Sure.
Well, why is it 500, 600 pages? That's because they're giving stuff to other folks. They have just one page, right? And 499 for everybody else is getting their share.
Who has the time to read all those pages?
Right.
So you're missing out, and you're paying the maximum amount that they could take from you. I mean, of course, they're taking Social Security and Medicare right off the top, and then they get into the income tax, and that's growing. They gave, the prior administration gave the rich and the large corporations big tax breaks. Can you imagine Amazon doesn't pay any tax?
Amazing, isn't it?
Amazing. But we have to file and pay tax. Why is that?
Right.
That is outrageous.
And that's why, if the American public understood what was going on, and I hate to say this, though, we know we had this insurrection back on January 6th. Right. If they really knew what was going on, the American public would have been storming the Capitol and say, hey, y'all just, did us a bad one. Y'all just.
That's right. That's right.
They would really, and they know that most citizens are financially illiterate when it comes to these things, and that's how they can get over on this, and that's unfortunate. I said if I had to run for president, or anything, I'd run on one thing. This is the one thing I would run. I'd run on the fact that you should be able to get Social Security at the earliest age, like 62, and not pay any taxes on it, and make as much money as you could.
That's right.
Because the whole tax situation, the whole economic system has changed, right?
It really has.
When Social Security was started, 40, 50 years ago, you can't subside, you can't live on what they pay you for Social Security. So most citizens, most Americans have to continue to work past 62. Absolutely.
And it's interesting you mentioned that, because Social Security, you've already paid the tax on it.
Thank you.
And now they're saying, well, because you have other income every year, you got a pension and you got other things coming, we're going to tax some of that Social Security again.
It defies one of the basic principles of financial planning, which you just said. You already pay taxes on it, so why you get paid taxes when it comes out?
Absolutely.
It doesn't make any sense. The Roth IRA is on that principle, right?
Right.
You pay taxes on it when it comes out. And if most Americans understood that, they would say, okay, I'm only going to vote for congressmen or senators or whatever that support the fact that if I could take my Social Security at the age of 62,
that's right,
I can continue to work and not have to pay any taxes on it. That'd be my thing.
They play the game with Social Security. They tell you if you take it at 62, you're going to get a reduced amount. But if you wait until you're 66, you'll get a higher amount they call full retirement. And then if you wait until you're 70, you will get the full amount. The problem is, if you between your 66 year and your 1970 year, and when you're 70 years old, it's going to take you 12 years to recover what you lost in those 4 years. Now,
so with that in mind, do you recommend folks take it at 66 and a half or whenever they're
66 and a half?
Right.
I say you take it at 66 and a half, and now you don't have to pay tax on that. You get the full amount, and you go forward. Because if you wait until you're 70 to take it, you got to live until you're 82, and then you got to hope you live past that to get it. And if you wait until you're 67 and you die the next day, it's gone. No one gets it.
That's crazy. Now, the way I understand it, Jim, is that if you at 66 and a half, your normal retirement age,
right?
If you take Social Security, you could continue working.
Yes.
They add that Social Security to your wages,
right?
And then you pay taxes on the total amount. Is
right.
that right?
That's exactly right. You get to, I mean, you don't get penalized, but what you have to do is pay taxes on 85% of the Social Security you get. Now you have to pay tax on that, but you don't lose the benefit. Because if you start taking Social Security before 66 and a half, and you make a certain amount, they're going to reduce your benefit and you're going to lose out and you can't get it back.
Right. And that's the thing, that if most Americans understood that, you never hear any politician, talking about what we're just talking about, explaining to them and say, you know what? And now what I heard is that if they did that, the problem with it is that if folks were able to take it at 62 and not pay any taxes on it and make as much money as they can, that would devastate Social Security. It is not
right.
The actuarial part of it says, no, we can't, do that. Because my understanding that they've tapped into Social Security for other stuff as well, too.
They do. They borrow money from it. Yeah. And they use it. And they put an IOU in it. So they don't really want you to take your Social Security at the full amount at 66. They're hoping you wait until you're 70 and hope you die. And they get to keep it.
And can I get something? Can I get something else off my chest?
Sure.
Okay. This is my thing. Okay. You remember, I mean, you're a couple of years older than me.
Yeah.
You remember how 401k and 403bs came about. You remember Reagan back in the 80s, he said, guess what? We're going to do away with pensions.
Yeah.
He's had pensions, right?
Sure.
Right. They did away with pensions. They said, oh, we're going to replace it with this 401k. And here's the great thing about it. You'll be able to manage your money. The only problem with that was it's almost like you give a teenager the key to your car, but they don't have a driver's license, because most people just didn't know how to manage their money. So they gave all these projections on you'd have $1.5 million, $2 million, and all this kind of stuff. And that was exciting. And so what happened was companies did away with pensions. I'm not going to get into why they did that, because that was the 80s, was the Raiders time when they were raiding companies. You remember all that?
I remember.
Maybe some other, but they did that and people thought it was great. And then what did they have to do? They had to make amendments to a 401k that you could take it out for this, you can take it out for that, because people were socking money in there. People were losing money because they didn't know how to invest.
Exactly.
And so I think, once again, the Americans were sold the bill of goods. I don't think I've met only one or two people that have had enough money in their 401k in order to retire on.
Well, remember now, the 401k, you're really taking some of your money, putting it aside for when you retire. When the pension plans were there in full bloom, the company, you still got your salary, and the company was putting in additional money in a pension plan for you to get when you retire. So the employee was really getting a double amount. You got your whole salary, plus you got a pension benefit. But with the 401k, you're just deferring part of your money. And now you got to worry about investing it, like you said, properly, or it won't be there.
Exactly. And one of the reasons that they did that was because, in a pension, you have to put enough money in there to make sure that, all the beneficiaries would benefit from it.
That's right.
What happened in the 80s when the stock market was going up, pensions were doing very, very well.
Very well.
So the Raiders, the folks that bought these companies, all they had to do is say, okay, we have, I'm making up a number. Oh, we have $1 million set aside for all the beneficiaries. But you know what? We have 10 million in the pension. So they can recapture that.
That's right.
And say, oh, we're going to take that. So they would use that when they would go to these companies to buy them. They buy them out, see the overfunded pension. We could take that. Plus, here's the other thing, Jim. I know you'll like this. They had real estate on the books at cost.
Sure.
So guess what? They
It's worth
knew
more than
that,
that.
oh, that's a double whammy. I'm going to reevaluate the real estate portfolio.
That's right.
I'm going to take and I'm going to sell it off.
That's
And
right.
then I'm going to take the overfunded pension liability and
Right.
take that. Guess
That's
what?
right.
That reduces my cost in buying that company.
Absolutely.
That's as simple as it gets. If Americans knew that, they'd be so upset.
But it's too late. It's too
It's
late.
too late. It's too late
now. You know,
It's too late now.
we've come down the road now. Now we got to work hard and hope the government doesn't ask us for more money.
Exactly.
Now you know what they're
that,
trying to do now.
But
They're
that's
trying
why
to balance the budget.
But that's why
they weren't balancing the budget 4 or 5 years ago, but now they're going to balance the budget. And you know how they're going to balance the budget? They're going to raise taxes on the middle class. I mean, how else are they going to do it?
And where are they getting these trillions of dollars for this pandemic? I mean, they're going to offshore account somewhere?
It's a loan. They're borrowing money on your tax dollars because they're going to raise your tax dollars to pay it off. I mean, we have a deficit that you can't believe.
Yeah. And
you can't spend money that's not in your bank account, but they are.
Yeah, and that's the biggest problem, you know. Anyway, I just share that because a lot of folks just don't understand what's going on. If they really understood what was going on, they'd be so upset. And because they're not looking for an educated populace that understands. Now, some of the high net worth people, they understand this stuff. That's why they get the tax break when you're making over 400,000. But the fact that they're dickering around with, hey, listen, we're gonna give them 1,400, 2,000, we're gonna give them 3,000 credit per child. You know, all this stuff is smokescreen. I'm like, well, I'm gonna say, well, what's the other guys getting? I mean, it's like like your brother and sister, you're sitting at the table. Well, what is Johnny getting for Christmas? You know, I want to know what Johnny's getting. I want to know what my brother's getting. That matches up with what I should get. And we're just getting and then, and I'm gonna get off this little thing. And then they got it where they don't even know where some of the money is.
No, they don't.
No, they don't. All kind of fraud going on and stuff like that. So
there you go.
Anyway,
Count on it.
So that's the thing. So let's get into the areas that you specialize. Now, when I met you, you were doing taxes, and you're not doing as much of that anymore. You're more involved in wills and trusts and estate.
That's right.
Give us a reason why someone would want to have a will. Does everybody need a will, first of all?
Everybody should have a will. They should have a formal. It doesn't have to be a complicated will. Everybody should have a will.
Okay.
Because the will is the one document that says who can be your executor. It's the one document that the courts will say this person was elected and nominated by the decedent, so that person controls. So you got to have a will. Now, there are other things you should have, but a will gives the executor the authority to marshal your assets and disperse it according to your desires.
Okay.
If you don't have a will, then the state has what they call intestacy rules. They will determine who gets what. That may or may not be what you want. So you need a will, and that will needs to be reviewed at least once a year. And I found that since we've had this COVID-19, I've had more of my clients updating their wills because we just don't know what can happen, when it could happen, and you got to get things in order. So everybody should have a will. I suggest you get someone who understands your needs and your complexities so that you can form it the way you want. Or if you don't want to get a lawyer to do it, you got to go on the internet and prepare a will. I mean, you got to have a will. That's important. Then I think you need to have a durable power of attorney. And you need that durable power of attorney naming someone who can handle your financial affairs in the event you can't. You know, just because you're married, you have a spouse, or you have children, that doesn't give them the right to collect your money and pay your bills. You have to have a durable power of attorney in place that's been executed, witnessed, and notarized.
Right.
And then the last thing, you must have a healthcare directive. If you're in a coma, you need someone who's going to make some decisions. You know, you can't count on the doctor just doing what the doctor thinks is correct. The doctor needs to communicate with someone you trust that's going to make decisions. Now, doctors are not going to just pull the plug, but most doctors will not pull the plug, and they'll continue to use up all your funds and let the hospital collect everything, and you're really brain dead. So you need those three things: will, durable power of attorney, and a healthcare directive. Everyone should have that.
So you're saying will, say it again, a will.
A will, you need a will.
Okay.
And the will says, this is who I want to handle things in the event of my death. Now, the will is not effective until you die. So you can change the will every day of the year. And it's the last will. That's why they call it the last will and testament. The last will is the one that counts. The healthcare, the power of attorney goes into effect while you're alive. And the healthcare directive goes into effect while you're alive. But upon your death, those two go away, and the will is what controls.
Now, do you need a do not resuscitate, plan? Is that something that would go?
That would be in the healthcare directive.
Healthcare, okay.
In that healthcare directive,
is that the same as a health? Is that the same as a healthcare proxy?
Yeah, the same thing.
Same thing. Okay.
Same thing. Same thing. That's exactly right. In there is do not resuscitate. It talks about the kind of medication you want or you don't want. It talks about putting you on a respirator. I mean, it talks about everything.
And that's important because a lot of people don't think about that. I think with COVID coming around now, and people having personal experience with death, more so than they normally would.
Right.
I know personally 3 or 4 people who have died from COVID.
Yes.
Of course, unexpectedly. They didn't know. And it puts it all in a proper perspective. And here's the other thing: before a will, would you not want a document? And I have this document that my insurance agent provided for me. It's a booklet, and it's really great. And it has not only where your will is and all that stuff. It's not.
That's right. That's right.
But it has things like assets, liabilities. It has passcodes.
That's right.
It has things like that because if someone dies, how are you going to access their accounts?
Right. Fantastic. Or where the accounts are. All right.
Where the accounts are. Exactly. What the passcodes are.
Right.
I have a relative now that's involved with that. Her husband passed away.
Right.
So, she didn't have access to his pension account.
Right. That's right. That's right.
His other accounts, his bank account. I mean, they just didn't think about that.
Right. But you're right. That locator will help them to know where it is, but no one can go and access those things unless they have a will that is filed with the probate court. And the probate court appoints and authorizes the person you've named in your will to have the authority to go and do that. Because when you go to the bank and they say, well, now I know cousin Jim had this account here and I'm trying to take care of things. They said, fine, bring us letters of testamentary from the court or letters of administration from the court. It gives you the authority to open the account, to take the money, to transfer the property, to do all those things. Now, when you prepare the will, though, I always say you don't put it in a safe deposit box at the bank because you can't get in the safe deposit box. Right. You have to put it in a fireproof box in your house, under the bed, or up in the closet. Someone can get to it and pull it out and take it from there. So, and you put all your documents in one place: the will, title to the house, title to the car, the deed, the insurance policy. Put everything in one place.
And that makes a lot of sense.
It makes it simple.
People don't think about that as much as they did before, in terms of looking at that. So give us an example of, in addition to the will, should a will be, because I'm understanding that a will is read after the death.
Yes,
so
that's right.
Tell us the things you do not want to have in a will.
Okay. What you don't want to have, I'll tell you this. As you go, you want to put in the will the item that you can't put into a trust. I like having a will and a trust to go along with it. You can transfer to the trust all the things that you have currently, such as the title to your house, the title to your bank account. You can just put everything else in there. But what you can't put in there, your clothing, your jewelry, things that don't have a title. Does that make sense?
That makes perfect sense. You
Yeah.
know, in terms
So,
of trying
so,
to,
so the thing, so you always want to put things in a will that you want to change very often, but things that you've already made permanent decisions as to where they're going to go, I would have a trust set up, and it's called a living trust, revocable trust, that will allow, and the trustee can be yourself or your spouse or both of you. And what will happen is that upon your death, the court nor your will has anything to do with that trust, because that trust is separate and apart from your will. So anything that you have permanent decisions about, put it in a trust. Things that you're not sure about, such as jewelry, inheritance of various things, you leave in a will. But the will should mainly be the document that says, here's who's going to control my estate. You want to name the executor, an alternate executor. You want to name a trustee, maybe a successor trustee. And in there, you want to say anything that I haven't thought about listing in my will here. I want all of that to be collected and where I want it to go.
So here's a question: what is a living will? Is that the same?
Good.
Is that the same as a last will and testament?
No. Good point. A living will is the old name for the healthcare directive, because what it did was it talked about all while I'm alive and I'm near death, all the things I want done. So that's the healthcare directive. But now the trust I mentioned is, and you have what's called a living trust or a decedent's trust, testamentary trust. You want to use that to prevent your children or anyone else from spending the money however they want, because you made decisions in that trust as to when they're going to get it and how they're going to use it. If you want to control it from the grave, you get in a trust.
Well, let me tell you one of the things I did when my daughters were young.
Yeah.
I took out $1 million policy.
Yeah.
Okay. And my attorney at the time, he directed me to set up a trust.
Okay. What, insurance trust?
Irrevocable trust.
Right. It was an insurance trust and the trust on the policy.
Yeah. And so, I had to get educated.
Yeah.
This is like 25 years ago. I had to get educated. He said, well, the reason that you want the money going into a trust,
right,
because children, well, first of all, the children can't receive $1 million.
That's right.
And I said, well, why not? Well, because they're not going to give you $1 million in cash. Okay. Right. They're going to give it to you and put it in a bank account.
That's right.
Well, guess what?
Right.
A minor can't open up a bank account unless they're a custodian.
That's right.
Really? Why not? Well, right. Because a bank account is a contract.
That's right.
Minors can't sign a contract.
That's right.
That's why you hear these child actors and actresses, have their parents or guardian over the money they receive, right? Because that's going to the bank.
That's right.
And he said, so I had an executor, which was my sister.
Right.
And the way the trust was set up was if I had died, the $1 million would go into a trust.
Right.
Then I had direction that, okay, I'm not going to give them access to that $1 million.
Right.
So they could go into the trust for regular expenses, housing, food, clothes, all that kind of stuff.
Yeah, right.
But then at certain points, they would get, like, say, for example, at 18, they get maybe $100,000.
Right.
And that would be for like college education.
Yeah.
Then they would, get money for that.
That's
and then
right.
At 22 or 23, they get another lump sum if they wanted to buy get their career going, maybe buy a house or whatever.
That's right.
And they got money along the way. So you never gave them all the money at one time because you're going to blow some of it,
And that's controlling it from the grave. And that's good. And you need to be able to do that. Now that's what a trust is all really good for. You don't want to put that in a will, because a will can't the typical will, the longest a typical will can last is 10 years. So after your death. So, and you want this to last for a lot longer.
Mm-hmm.
That's why it gets into a trust.
Right.
And the trustee will manage that and control and do what you laid out. You know, I typically have in the trust where the trustee can provide for their health, education, and welfare, but at 30, they're entitled to a third. At 35, a half, and then at 40, the balance. You know, because you want to get them to the point where they're mature enough and they can handle it themselves and they can grow. Now,
right.
I did have one client that said she doesn't want her children to get it until they retire. I said, well,
really?
What happens if they die and they don't retire? She said, well, then they didn't need it. So, I don't recommend that.
Well, you know, I hear these stories, and I want to say Bill Gates and some others said they're not leaving any money to their children. I'm like,
that's right.
What's the joy in that you've made all this money, in his case, billions of dollars, and you're going to give it all away? You're not going to give it to any of your kids.
Well, you know, I think what happens is the theory should be you have raised your children, you provided education for them, and you've taught them how to fish. So, and you want them to be able to do that, but you don't know what's happening to your grandchildren and great-grandchildren. So a lot of my clients will put money into a trust for their grandchildren and great-grandchildren because they can't trust their children to do what you did. You know, you taught them how to fish. You didn't give them fish, but you provided them how to go out and fish for themselves, and you helped them along the way. And you realize that education is what it's going to take for the next generation. Right. So we do that. I do a lot of that. I told my son, no, you've got your portion. Now I'm looking out for my grandchildren.
Right.
And we're hoping that one generation takes care of the next.
Right. And I guess though that's for the other folk to do that, but we know with our people, they don't need that money. For the most part, they don't need that money. And I also would say that maybe the billionaires gave them some money already.
Yeah.
You follow me?
Yeah,
they said they ain't leaving nothing for them. Yeah. That doesn't mean they gave them 100 million, 50 million, 20 million,
right?
Whatever.
Oh, they gave them a start. They have a start.
Yeah, they got something. They got something. Yeah, they may set up a trust for them, whatever the case may be.
Right. But it's important to have that will and have a trust and have a healthcare directive and also have a durable power of attorney in place. Something that says if you can't make financial decisions while you are here, you're comatose, you need someone making decisions, paying the bills, taking care of the mortgage, running things the way you were doing it. Now, typically that's a spouse, but it doesn't have to be. And the spouse can't do it unless the spouse has a durable power of attorney.
Got it. So let's talk about the services that you provide. So we dealt with wills already. So what's the difference between a simple and a complex will?
Good. A simple will says I leave everything to my spouse, and if my spouse predeceased me, I leave it equally to my children. And you name your spouse and you name your children. And if you have more than one child involved, then you say, it goes to them equally. And if one dies and that child didn't have a child, then it goes equally to the remainder. All right. That's a simple will. You're not getting into planning for education. You're not doing anything. You're just dispersing what you have.
Got it.
That's a simple will. A complex will gets into establishing a trust upon your death, and because you can create one now, but you don't have to create a trust now. You can say, upon my death, I want everything to go to my spouse, and if she were to die, because I have young kids, I want a trust to be created at that time, and I want to name someone to be the trustee. And here's how I want them to manage the money, just like you were saying before.
Right.
Okay. But you didn't create a trust yet. You have just said in my will, this is what I direct my executor to do upon my death.
Got it.
Right.
Got it.
That's getting a little bit more complex because now you have to decide when, how, and who's going to create the trust, what the trust is going to say. You're now getting into remainder items and who gets what, and you're dividing things up between your sister, your brother, another relative. You have heirs property involved, where you got from your grandparents, and they want you to give it to a certain person, or especially when you're in a second marriage, and there are children from the first marriage and children from the second marriage, and you got to provide differently for them. So that gets complex.
Okay. So so you have the simple and the complex wills.
Yeah.
And, which is, that's pretty explanatory that most people need simple, but some people may need complex because
that's right.
Issues you just addressed.
Right.
Now, what is probate administration? Explain that for me.
Good. Good. Well, what happens upon your death, whoever you name in your will as the executor, that person will take the original will that you've signed, and it was witnessed by two independent people. To make a will valid in Georgia, it needs to be someone of at least 18 years of age. It was signed while you were in sound mind and body. Two witnesses notarized that fact. Witness to that fact, and they notarized it. And so that's filed with the court in the county where you live for at least 6 months before your death. Now, that court will issue, and that court is going to put in the newspaper that you died, and that court is going to contact all your heirs, all your blood heirs, and say, listen, a will has been filed here. Do you want to contest it? This is part of the probate process. Then the judge says, okay, fine. We either have someone contesting the will or not contesting the will. We're going to issue letters of testamentary. It's a letter that says you have the authority, that person you've nominated, to go to the bank, to go to the insurance company, to go everywhere and collect your assets. If you don't have a will, then a petition is still filed 6 months in the county where you live before your death. And now you're asking the court for letters of administration. That means the court is going to control it rather than letters of testamentary where your will control what happens.
Okay.
And that process, whoever you've appointed has to do what the will says. They take the will and they disperse the funds according to, after they pay bills, they disperse it according to the way you say it. And then after you've done all that, they go back to the court and says, Judge, I've done everything the will says, or I've done everything according to the laws of the state of Georgia. And I want you now to close the estate. So the probate process is opening up an estate, determining where your assets go, how it should go, to whom it should go to, and then it gets closed at the end of the process. That could take anywhere from 6 months to 10 years.
Wow. So now estate planning, I shared a little bit of my estate planning, what I did with my kids, how complex, that's a simple part. You have an insurance policy, goes into a trust, and then it's administered according to what the trust, documents say to do. How much more complicated can it get than that?
Well, the estate planning gets involved when taxes get into it. For example, right now, there's estate taxes. There's taxes on wealth, and the exemption from that right now is $11.5 million, and that went up that high because the Republicans wanted it that high because it helped the rich people.
Right.
But 10 years ago, between 5 to 10 years ago, the exemption was a lot lower. So you had to try to plan to get things out of your name into an irrevocable trust so that upon your death, 49% of that didn't go to the IRS.
Wow.
And right now it's 11.5 million. So most of us don't have that problem, but the Democrats are going to bring that back down from 11.5 to something like $1 million or so. So that means if the value of what you own at your death, let's say your house, you're the owner of the insurance policy on your life, and you have investments. If that's worth $5 million and the exemption is $1 million, now you got $4 million you have to worry about because the government's going to take half of it.
Half of it. Wow. And I've heard, analysis saying that the rich folks can afford it. Right. It's not like they can't. It's just that they're not passing on as much as they would like. Right. When you start talking about $200 million estates, we're talking a lot of money here. Right. And of course, they got the lawyers and accountants just like you to help them find ways to get around a lot of that stuff. That's our job. Yeah. That's the job to do that. Mm-hmm. And they do it. And of course, obviously, they do a very good job of it because they make sure that the politicians enact laws that their accountants have told them that they need. He said, hey, that's right. And it gets very specific too. It gets specific by industry and stuff like that. So, that's a good problem to have, that you're worried about. You have so much money, you're worrying about half of it being taken.
That's all estate planning is about, is maintaining and passing on to your heirs what you've earned in life, rather than giving it to the government. You're planning your exit from this earth to make sure your children have it. And that's what estate planning. And if you don't do it properly, they will take it.
Right. So what is guardianship? Explain that. I kind of understand a little bit, but explain where you might need some papers drawn up for guardianship.
Yeah, very good. Guardianship and conservatorship. When you are at the point that you can't handle things for yourself, you're either dementia sets in and different things happen where you can't make those decisions, then someone has to petition the probate court to appoint them as guardians, because guardians take care of the body, the person himself, and conservator takes care of that person's money. So they typically petition for guardianship and conservatorship. And then the court wants to say, well, now we need to make sure that this person doesn't have the ability to handle themselves and it does have dementia to the point that they don't know what's going on and they will end up just giving it away, not knowingly. They will appoint a guardian ad litem, another lawyer, to have that lawyer challenge what you're trying to do for your parents or whomever, and to make sure that it's absolutely right. And when it's right, and they say, yes, the doctors say that this person has been affected in such a way that they can't handle things for themselves, then the court says, fine. But the court says, I want that guardian and that conservator to report back to the court yearly, telling us what came in, how you spent it, and what went out, and they want it in a separate bank account. And they will require that conservator or guardian to get a bond, a surety bond that says $100,000, $200,000, depending upon how much money the ward has, to be sure that you don't run off with their money. Because the court doesn't want to have to come looking for you. They want the surety company to come looking for you. But you do want to control your elder parents and grandparents. You don't want them being praised of people coming along and stealing their monies. And that's what it's all about.
So now we've covered all that. One of the areas that you get into, which I'm assuming a lot of people are interested in, is IRS representation.
Yeah.
Explain about, now I've seen a lot of stuff. You got about 6 or 7 things that you handle. What is the biggest thing that you handle for people when it comes to the IRS?
Well, the biggest thing is it's usually either they haven't filed their taxes or and the IRS finally finds them and say, okay, now you got to file all these returns and we're going to hit you with not only the tax you owe, but all the penalties for not filing, not paying. I mean, sometimes that adds up to be just as much as the tax you owe. Or you get a situation where you have you made money and you didn't put enough tax on the side, and now you're trying to figure out how you're going to pay this liability. Right. Uncle Sam just wants his money. So Uncle Sam is going to, first thing he's going to do is put a lien against your property if you owe them $25,000 or more. I mean, they're going to put a lien, and all the lien says to the world is that you can't buy the property from Jim because we have a lien on it, and no one's going to buy any property that has an IRS lien on it because they don't have first dibs at it. Now, then the second thing the IRS does is we will levy your bank account, and because now they know where you are. Because they have your social security number and all that. So they're going to levy your bank account. And then they say, we want a constant stream of money coming in to pay up your debt. So we're going to garnish your payroll. So they, between putting a lien out there, levying your bank account, garnishing your check, they will collect their money over 100 years. They don't care how long it takes.
Wow.
and the unfortunate thing is, you want to correct this because you can't go out and buy any more property because as soon as you buy anything else, the lien automatically attaches. You can buy it, but you can't sell it. You can't do anything else with it.
And so at what point, well, first of all, is the IRS now a little bit more willing, I don't know, because of COVID or whatever, to negotiate with taxpayers in terms of working out something, or they just take a hard line? You owe 20,000, guess what? You're going to pay 20,000.
Hard line.
Really?
They don't, the only time they did that, maybe about 10, 15 years ago, when the IRS really had a bad name, then they would back things off. But now you got to remember, we have a deficit and Congress wants the IRS to collect the money. So you can't tell the IRS that, I'm a nice guy. I used to pay my taxes, but I got caught in this situation. And so therefore, I need a break. No.
They don't want to hear it.
They don't want to hear it. They don't want to hear it. They want to know where is your money or where can you get it? They want you to go get a loan to pay them.
So what leverage do you have in negotiating for your clients then? Well,
first you want to figure out what positions they are and what got them into that situation. And they have some first time mistakes that you might have made that you can ask them to do, or you can do an offer in compromise saying that, I owe you guys $100,000. Everything I own is $50,000. Let's work out a deal because I have bad health. My children have deserted me and this is all I have. And I'm willing to give you guys this to get off my back. So that's an offer in compromise.
All right. But in that case, you got to pay them all the money, right?
Right. You got to pay them all. They're not going to give you an offer.
Are you able to negotiate with states like with, say, Georgia?
Georgia's worse. Georgia's worse than the IRS.
Oh, wow.
Yeah, Georgia is, it's just impossible to do any kind of resolution with Georgia. They're just terrible. The IRS is a lot easier to deal with. You get to know them, you get to know the people, and they're trying to work with you because they want to get that case off of their inventory. And if you give them a reason, they'll jump on it. But you got to give them the right reason that their boss and their boss will accept.
Right. Got it. All right, Jim. Well, we got about a minute left. Just share your contact information and how people can find you.
Sure. Well, if you go on the web, jdbrownpc.com, you get to see the things that I do. My telephone number, 770-989-1990. That's my office number here. And my email, jd@jdbrownpc.com.
Great. We got a question.
We'll get back to you.
Are you or your guests with, debt insolvency?
Well, I'll tell you, we have done some of that. Not a lot of that. Not a lot, because it's mostly filing bankruptcy, and that's I don't encourage people to do bankruptcy. I really just don't.
Right. Well, James, thank you so much, for coming on, and I'm sure as the tax season goes on and other things around the state, then we'll be able to talk a little bit more. You're looking good there, my friend.
Well, thank you. You are too. Thank you very much. You are too, and it's been a pleasure. I enjoyed it. Thank you.
All right, James.
Okay. Take care now.
All righty. Take care,
Bye-bye.
man. Bye-bye.